Good morning and welcome to Real Estate Economics webinar series. I'm John Mulville, and today I'll be leading us through a look at the Dallas, Texas MSA. First, we'll take a look at the housing transaction trends, make an overview of the current employment climate, and finally some summary and conclusions regarding this MSA. First, our housing market overview. Those of you who are familiar with our closings report have seen this for your market area or in many of our past webinar presentations. The blue dots in this particular map are existing home sales. That's a category that can include short sales. The green dots are new home builder subdivision or tract development sales. Red dots are foreclosures. That's owner back to lender. And the yellow dots are foreclosure sales. That's lender out to a new third-party owner. As you can see, this is a single month's data, February 2012, and the resale market controls about 59% of the total transaction activity. Obviously, we'd like that to be much higher, and at the same time see a reduction in foreclosures and foreclosure sales. The new home market share, though, is about 9%. We would consider that right about the middle of the range for an MSA with decent employment prospects and good economics on the ground. We'll present quite a bit of data today about the trends for the foreclosures and the foreclosure sales. So if you look back through 6 years of data in this particular MSA, you've seen a little bit of oscillation in both price and dollars per square foot value ratio. Please let us note that the numbers here, these sales prices, include all of the above transactions. That's new home closings, conventional resale closings, and distressed foreclosure sales. So these particular months' worth of data can often oscillate a bit depending on how many foreclosure sales happen to close during that particular month. In the early periods of this table, the data had quite a few more new home sales and higher value ratios. You can see at the $93 per foot range. Then as time has gone by and in months where there were many more foreclosure sales, not only does the average sales price tend to taper lower, but so do the value ratios. Most importantly, in the last 3 years, we've started to see some improvement in the value ratios. The numbers in this particular table tend to vary. Lender performance tends to oscillate quite a bit. There are some months when lenders get more homes out than others. The lenders tend to perform at different levels in different markets, even within a submarket. So we do tend to have some ups and downs in these numbers. Overall, total volume, you can see cresting back in 2007 with about 5,500 sales. This is for a single month, recall, February 2007. So the volume in this market is quite substantial, troughing over the years or through the years with a monthly base, February 2011 of 2,806, but now coming back pretty robustly into 2012. We saw quite a few discounts for year-end closings at the end of 2011. Would anticipate the same thing for 2012. So year-end deal making is prevalent in this and almost every market we evaluate. We're going to go to a 3-year time period here and show, again, resales, new home sales, foreclosures in red, and foreclosure sales. Specifically, we'd like to see, or like to report, generally steady new home sales at a decent percentage, but declining foreclosures and generally increasing foreclosure sales. Now, many of the lenders are finding that foreclosing a home, remarketing it, getting it back out and available for sale has not been the best asset management strategy. Often it's been better to have a tenant or a previous owner stay in the home. They'll mow the grass, flush the toilet, that sort of thing, and generally keep better care until the asset's ready to be dealt with. Foreclosure sales we are seeing go out to the outer edges of the price spectrum, if you will. Homes that are either far below market or far above market tend to end up in foreclosure sales more often than bread and butter product, which we see as being scooped up quite efficiently by landlord rental investor types. Let's look at the total distress percentages here. If you can, I'll draw your attention to the foreclosure owner-to-bank numbers 2 years ago, 1 year ago, and current February. 19.8% in 2010, 19.6% in 2011, and now all the way down to 17.2%. Many of these asset managers have improved their processes, improved their staffing levels, and we see those numbers coming up appreciably. A lot of that volume goes into the resale category because that's a category, again, that can include short sales. So as those lenders push homes over into the short sale category, those numbers are coming up while the categories of distress have been coming down. We just talked a moment ago about the transactions by price range. This is the price spectrum. Very interesting things taking place here. You can see 2 years ago is in the yellow. February 2011 single month is in the pink, and the current numbers in the blue or purple, depending on how that looks on your screen. You can see the migration to the right side of the price array here. This has been typical of almost every market we're active in. Lower price units have been drawing rental investors for many, many months now. We have found the rental investor to be a pretty efficient business operator. They've been able to find the values, purchase in many cases with all cash, immediately take control of a home, turn it around in fairly short order, and have that back on the market with a cash flowing situation in really just 4 weeks, 6 weeks, 2 months at times. I think this has clearly manifested itself in the great performance of companies like Lowe's and Home Depot and the big home improvement chains who've seen a lot of this activity, those people coming into their stores and buying all kinds of things. We look at this market in terms to loan to value. We know that lending standards have tightened appreciably over the last several years, at least in homes. It certainly doesn't appear that way in automobiles. So we'd like to watch these loan to values and see if those numbers remain at least within reasonable boundaries. We think over time, there's a lot of push to get more loans out there and to get more people refinancing. So we'd like to see these numbers at least remain reasonable and have buyers who are using loans have at least some equity into their purchases. This is an array of distressed units with a general price regression line right down the middle. I call your attention to this for a couple of reasons. One, we would expect to see the foreclosures and foreclosure sale volume in the pink and the burgundy at the bottom. That's all normal. Then above that is the resales, and closer to the top and in the larger footage sizes are the new home sales. What we'd really like to call attention to here is if you go to about the 3,000 square foot mark along the bottom axis, what you'll see is a real dropout in foreclosure and foreclosure sale volume. That tells us a couple of things. One is that the people buying the foreclosures and foreclosure sale inventory are interested in renting those. Typically, we have seen this has been a difficult area for the owner-operator to function in. They tend to get discouraged. They have a hard time doing the inspection and having the money ready to go at the courthouse and that sort of thing. But what we just don't see much activity in is the purchase, remodeling, and conversion of a distressed asset in the larger footages into a rental house. Now that may come over time. We know that there are larger homes in the REO asset base, just maybe not coming out in full volume at this point in time. So what happens if we take all those dots away from the previous screen and just show the regression lines? You can see the pricing relationships between new homes shown in green. That's really the highest line. The blue homes are resales. That's the conventional resale. One more time, that's a category that does include short sales. And the foreclosure home regression line, that's the bottom in the red. Almost every market we go to, we like to see some orderly price differential between the new homes and the resale homes, and then between resale homes and foreclosure homes. So what can we tell here? Just on a quick analysis of this, if you look how the green, the upper line, and the blue, the middle line, tend to come together in the upper price ranges, that tells us that the builders don't have that much pricing power in the upper price points at this point in time. Again, this is for a single month, so even though the database is pretty large, keep it in context. So we think builders, and we can see this from the data, have been doing everything they can to keep homes affordable, to make homes affordable in the first place. Sizes have been coming down in most of the markets we work. Lot sizes have been coming down, i.e. densities are increasing. They're trying to put as many homes within the reach of buyers as they can, so what we see is a little bit of those two lines coming together. Now, by comparison, look at the foreclosure line. That tends to drop away very severely from not only the resale line, but especially from the new home price line. This goes back to the point we made in the last slide, that there tends to be much larger discounts in the larger unit sizes for the foreclosed homes. Completely to be expected, not a product, if a 3,500 or 4,500 square foot home doesn't have that much rental market appeal. We think that ultimately owner-occupants may step into that market in a limited way. Otherwise, it provides an excellent opportunity for remodelers in the markets that have good employment. Let's take a look at that employment. Again, Dallas MSA. As you know, real estate economics is based in California. It is great as a Californian to see some markets where the employment conditions are excellent. We've had a long struggle to recover in employment here in California and have generally lagged the nation. By comparison, Texas and Dallas has been leading the nation, so we're very encouraged and always happy to see numbers that look like this. You can see the areas of growth. For many years, I think Texas was considered a market where employment costs and operating costs tended to be low. Workers' salaries, not necessarily low, but they were certainly a bargain compared to the big employment states, California, New York, that sort of thing. That is changing. This is a market that has seen a lot of improvement in both mean wage levels and also their concentrations into certain categories that tend to pay higher wages, such as management, business and financial operations, computer and mathematical fields, architecture and engineering. Those are fields that have grown very robustly in this area, which is really a great thing for the MSA as a whole and a good thing for the housing market. Now this is again a one-year comparison, February 2011 to February 2012. Let's go back 1 year and just look at how this compares to a year ago. Still good growth, but there's a little bit of a, industry shift. And we know this is how, recessions work. Historically, we see investment capital come out of poorly positioned, uncompetitive industries and go into new industries or go into other industries that are performing better. That's certainly the case across the country. We've seen that dramatically impact state economies, where the states that are uncompetitive, the states that have uncompetitive labor practices and just can't provide workers and housing and office space, energy, all this sort of thing to companies, they've tended to lose employees, sometimes in droves, and the states that are competitive and have the good environment have gained in droves, and that's certainly the case here. Look at the numbers in the categories we just talked about: business professional services, financial activities, trade, transportation, and utilities. We recognize here that energy is a big part of the economy here. It's certainly been growing in response to all the growth in fracking and non-conventional drilling techniques, and also into industries related to the trading and transportation of these energy things, with the huge oversupply of oil going into Cushing and trying to get some of that down to the Gulf Coast. Here's the year-over-year trends for this particular market. Now this is a huge contrast to many of the areas we work in. If you've seen our webinars over the past few months, the characteristics of these 12-month employment changes vary tremendously from MSA to MSA. We saw certain MSAs that didn't respond at all negatively to the dot-com boom and bust in 2002 and 2003. As this market obviously did. At the same time, we've seen markets that essentially started to have tremendous erosion in their employment base in 2007, with 2008 being a real bad year, and sometimes that continued into 2011 and right up to the present. Look at this particular market. The big downdraft was literally confined to about a 15 or 16 month period between late '08 and the middle of 2010. 2010 turned out to be a very positive year, as has 2011. We still have MSAs, many MSAs, but a decreasing number across the country, where 2010 was a poor year, a stabilization year versus a growth year, and 2011 is just showing some inklings of improvement, whereas this particular area, 2011, looks very, very strong with continued uptrend forecast through 2012. I'm going to take a quick moment and talk about interest rates. This is an area of particular interest. If you look back, this chart goes to 1990, but really the U.S. has had declining interest rates and mortgage rates since about the early 80s. That provides a tremendous tailwind for housing. If you can refinance your house every couple of years and take a point or two off your interest rate, you can own that home for perpetually cheaper monthly payment. Now, what happens in the out years of this particular forecast? We start to get a reversal in rates. Usually higher rates are associated with stronger economic conditions, but it makes that same house, it makes that, say, $250,000 house, that's going to take more and more money every year to buy and to make those payments on as rates accelerate in the outer years of this forecast. Now, economic weakness is pretty prevalent across the globe at this point in time. Obviously, if you watch the news, Europe's in bad shape. Many of the BRIC companies and the emerging market companies have seen their purchasing manager indexes roll over. India, China, just to name a few. There's huge monetary easing in Japan. So we don't know how fast rates really are going to come back here. All that international weakness takes a lot of pressure off the U.S. to raise rates and get rates back up where they need. However, if these European economies and some of these places can't meet any austerity goals and continue to spend far above their incomes, then we're going to ultimately see a rate response out of those markets that could go around the world. So what's really our conclusion and summary for this particular area? Texas has led the country numerically in new jobs, 245,000. That's on a year-over-year basis, and has dwarfed the performance of California and New York. Both are not nearly as competitive in our view in terms of employment friendliness, that sort of thing, and it has brought big jobs to Texas, not only the Dallas MSA, but others. Look at the unemployment rate. Texas down to 7%, down from 8% 12 months ago. That's really in about the top 20, just about the top half nationally, but you have to take into account that the strong job performance in this market has pulled in lots of people from other areas. Mobile workers without jobs have come here looking for work, and so that tends to grow the labor force. And it adds to the employment base, but it also slows the drop in unemployment. I've got a couple numbers here in the middle. Houston MSA plus 93,000 jobs in the past 12 months. That's a huge number even for a state like California and New York. That's number 2 nationally. Dallas, number 3 nationally, 79,400 new jobs in the last 12 months. Number 3 nationally. Fabulous conditions. Wages have improved and growth is strong in high-wage industries. We talked about this a moment. Overall measures of competitiveness. We talk about this quite often in our webinars. We talked about it earlier today. The states and the MSAs, and even on the city, county, regional basis, on an international level, businesses looking for climates where they can operate. And, that's really a multifaceted situation. We need competitive, well-educated workers. We need, stable power, good transportation. We need places to office and warehouse. Texas is a market, and Dallas is a market where competitive conditions are good, and it's a draw to companies looking to locate not only within America but across the globe. One more thing, cash sales to all cash and absentee buyers. That's been at very high numbers. That's our investor pool that we talked about. And permit levels have stayed low in this market. They've come up a little bit. We've seen that, but we haven't carved out maybe a 5 or 6 or 7 year trough in permits like we have in some of the deeply affected markets. It's been a sharp stab down in 2008 and 2009, a shorter trough of 2010 and 2011, and now we're starting to see some build here. Now, those numbers are way too low to overbuild the market, but we've started to see some improvement, which we think is encouraging. Here's an overview of our product. As you know, I'm in the consulting group. We do site-specific feasibility work, supply and demand, our land value optimization. If you own property and are trying to get the best product with the best price at the right mix, the right density, the right absorption rates, that's where we come into our land value optimization. We do quite a bit of work in workout valuation analysis, as is work, value of partially completed improvements, and we also make 5-year forecasts on most MSAs nationally, so we can talk to you about market appreciation potential and forecasting. Many of the things you've seen here today in our webinar are part of our web-based information tools, closing reports, new home profiles. Our residential economic reports covers the macroeconomic work for your particular MSA. If you're considering entering an MSA, we'd strongly recommend a residential economic report so you can know that market and understand the issues before you spend a lot of time on the ground. Here's our group. I'm John. I'm the one who's delivering you the presentation today. Many of you know Mark. He's the principal and owner of Real Estate Economics. Please call us as you see fit. We're happy to field questions about anything we've presented today or the market in general. Our sales and support group, Judy and Sandy, are shown below. They can help guide you to the appropriate product for your need and also help you get the most benefit out of the things you buy from us. There are many, many uses for some of these things that aren't readily apparent that we can happily coach you to so that you can really get a lot of value for your research dollar in today's environment. Now please check our website. We're going to post the next few weeks of webinars there, and we'll try to keep that updated and continually reflecting the changes that we put into that schedule, so when special topics come up and special market events occur, we like to occasionally work in a special topic. Thank you for joining us today. I'm John Mulville again. Please call me if you have any questions or interest in anything we've addressed today, and join us for our upcoming webinars.